The president steps forward with a bold announcement, a major deal that will supposedly flood American markets with affordable oil, keep gas prices steady at the pump, and reclaim U.S. energy leadership on the global stage. Wall Street erupts in applause. Political supporters cheer loudly. News outlets proclaim it a resounding success. But behind the scenes, the giants of the American oil industry, ExxonMobil, Chevron, ConocoPhillips, are far from excited. In fact, they're quietly stepping back. Once you dig into the figures they're reviewing, it becomes clear this isn't a golden opportunity. It's a cleverly disguised financial pitfall. Welcome to the unfolding Venezuela oil saga, where grand political visions have slammed headfirst into harsh economic truths in dramatic fashion. What should really catch your eye here is the scale. We're not dealing with a minor forecasting error or slightly overly optimistic projections. We're facing a potential $183 billion shortfall, one that could rank as the most massive loss ever seen in the American energy sector. And if things go south, everyday taxpayers like you and me might end up footing much of that bill when reality finally overtakes the hype. Let me break down exactly how this mechanism operates. Once you grasp it, you'll never view energy policy announcements the same way again. It all begins with the promise. Venezuela possesses the world's largest proven oil reserves, around 303 billion barrels, surpassing even Saudi Arabia, Russia, or anything in North America. For decades, sanctions kept that vast resource offline while U.S. gas prices rose and families felt the pinch at every fill-up. Now, with political shifts underway, regime change discussions, and improving diplomatic ties, the idea is to unlock Venezuelan output. This would deliver lower fuel costs for everyday Americans, greater supply stability for the economy, and reduced reliance on Middle Eastern sources. On paper, it sounds ideal, precisely the boost our economy could use right now. But the narrative quickly pivots to numbers that simply refuse to add up. Rystad Energy, one of the most trusted names in global oil analysis, recently released their assessment, widely covered in industry reports. To bring Venezuela's production up to just 3 million barrels per day by 2040, the country would need roughly $183 billion in total investment. Pause and absorb that. Not 3 million barrels tomorrow or even in 5 years. This is the goal for 15 years from now, starting around 2026. And that's still below their 1990s peak of about 3.5 million barrels daily when Venezuela was a true oil powerhouse. You might wonder, $183 billion is huge, but big U.S. firms routinely pour billions into Gulf of Mexico projects, Texas shale, or global offshore developments. What's so different here? The difference lies in two brutal realities: catastrophic infrastructure decay and deeply unfavorable economics. Venezuela's state oil company PDVSA hasn't seriously upgraded its systems in 50 years. While the global industry advanced with cutting-edge drilling tech, automation, and monitoring, Venezuela's network crumbled under corruption, neglect, and zero reinvestment. Investigations, including from major outlets, have shown pipelines suffering near-daily leaks, not rare incidents, but routine spills contaminating communities and the environment because the pipes are literally disintegrating. This isn't a case of drilling a few wells and cashing in. It's a full-scale reconstruction of a modern oil sector inside the ruins of a collapsed one, while that ruin keeps degrading. Every rig, pipeline, refinery, and storage tank needs massive replacement or overhaul. Before dreaming of profits, you'd first have to avert ongoing disasters. The timeline makes this refusal from major players even clearer. ExxonMobil, no commitment. Chevron, holding back. ConocoPhillips, staying on the sidelines. These aren't tiny operators, they're industry titans with vast resources and decades of global expertise. Yet they're all looking at the same data and choosing to walk away. But the upfront costs are just the start. Even if that initial $35 billion magically appeared, what would investors actually receive? The global oil market is currently dealing with a 2 million barrel per day oversupply. Prices hover around $60 per barrel, with Brent near $63 and WTI around $59 as of early January 2026, even as OPEC Plus works hard with cuts to prevent further drops. Meanwhile, Rystad and other analysts peg Venezuela's break-even price, the level needed to cover rebuilding, operations, transport, and turn a profit, at roughly $80 per barrel or higher in many scenarios. At today's $660, every barrel produced loses money from day one, not someday if prices dip further, right now, immediately. Imagine a Chevron executive explaining to shareholders, "We're proposing tens of billions up front in a nation with a track record of seizing assets, outdated infrastructure from half a century ago, ongoing 20+ losses per barrel at current prices, no positive cash flow for a decade or more, and constant political risk." The backlash would be immediate, and so would the lawsuits. This isn't high risk, high reward. It's a near guaranteed loss wrapped in talk of energy security and consumer relief. And here's why it matters to everyone, even non-investors. Political promises have already been made. Millions of Americans struggling with costs have been sold the story of cheap Venezuelan oil as relief. When private firms inevitably say no, what happens next? Pressure builds to avoid political embarrassment. Talk shifts to national interest, public-private deals, or direct government support. In other words, taxpayer dollars flowing into the $183 billion void. This is a financial trap with a political fuse already lit. The experts who truly understand the business are already distancing themselves. Take Hugh Daigle, a respected petroleum engineering professor at the University of Texas, training the next generation of industry engineers. When asked about the viability for U.S. firms, he stated plainly, there's no compelling business case for investing billions over decades to profit from Venezuelan oil. Not risky, but rewarding. Simply no rational math works. Major companies echo this in their careful non-statements. ConocoPhillips, when pressed, called it premature to speculate. Corporate code for we've run the numbers, and the answer is no. The silence from every major player with the capability to act is deafening. Adding insult to injury, these same firms are still battling to recover billions seized during past nationalizations under Hugo Chavez. ConocoPhillips holds around $10 billion in unresolved claims. Exxon has about $2 billion tied up in long-running arbitration. Why pour new money into a country that hasn't repaid old debts? Even setting aside history, the logistics are daunting. Experts estimate a minimum 10-year rebuild costing up to $100 billion or more just to approach meaningful returns. In context, global production is well 100 million barrels daily. Venezuela's current share is barely 1%, smaller than routine market swings. Spending tens to hundreds of billions to boost that tiny slice in an oversupplied world with a history of expropriation is a risk-reward disaster. Meanwhile, U.S. firms are happily investing billions elsewhere. Gulf deepwater, Permian shale, Guyana, Brazil, places with solid economics, legal stability, and contract respect. The fact they choose those over Venezuela speaks volumes. Now, let's look at the timeline math that seals the trap. By late 2026, optimistic case with full sanctions relief and perfect execution, production might hit 1.2 million barrels per day, generating $26 billion in annual revenue at $60 a barrel. But sustaining momentum requires $35 billion invested by 2028. If Venezuela can't generate enough cash to both run the country and repay investors, it's mathematically impossible without massive external help. By 2030, reaching 2 million barrels per day demands $110 billion plus deep systemic reforms. Anti-corruption, transparency, reforms experts deem unlikely given entrenched politics. Worse, the IEA sees global demand plateauing around 105 or 106 million barrels per day by 2030 due to EVs, efficiency, and renewables. Adding Venezuelan supply displaces others, pushing prices down further. Goldman Sachs estimated a $4 drop from added 2 million barrels, worsening losses. At $56, $60 per barrel versus $80 break-even, success becomes self-defeating. More production, powers bigger losses. This isn't speculation, it's math. The trap closes tighter the closer we get. Private firms will eventually exit, citing changed conditions. But political promises mean pressure for government intervention, turning this into the largest taxpayer-funded energy fiasco in history. The oil executives saw this months ago and backed away. Professor Daigle saw no business case. ConocoPhillips' premature is a polite no. The $183 billion Venezuela trap isn't a distant risk. It's already in motion, driven by announcements that ignore economic reality. Mathematics doesn't bend to rhetoric. Right now, reality is winning, even as we're told to celebrate the victory. The only real question, will we spot the trap before it's too late?